Have you ever looked at a price chart and noticed sudden sharp moves with little to no pullbacks? Well, those are imbalances and they hold the key to understanding how smart money moves in the market. In this video, we are breaking down how to trade imbalances, what they are, how to identify them, and how to use them for high probability trade setups. So if you want to refine your trading strategy and start spotting liquidity gaps like a pro, hit that like button and subscribe so you never miss powerful trading insights. Now let us get into it. Before we talk about how to trade imbalances, we need to understand what they are. Okay? An imbalance occurs when there is a strong one-sided move. When there is a strong one-sided move in the market with very little opposition. All right? When there is a strong one-sided move in the market with very little opposition, this usually happens because of institutional trading, where large orders get executed, leaving behind price inefficiencies. So think of it like a sudden surge in demand or supply, right? And that pushes price aggressively in one direction. When this happens, price often revisits these imbalance areas later to fill in the liquidity gaps, right? So how do we actually spot these imbalances on a chart? Let us go over that now. Imbalances are easy to spot once you know what to look for. Here's how you can identify them. One, look for large candles. If you see a strong bullish or bearish candle with little or no wicks and almost no opposite movement, that's a sign of an imbalance. Also, check the volume. All right. Large imbalances often occur with a spike in volume, showing strong institutional interest. And then you have to use the right time frames as well. Higher time frames like 1 hour, 4 hour, or the daily time frame reveal strong imbalance zones. They reveal strong imbalance zones. That hold weight in future price action. For scalping, you can just look at the 5 minute and 15-minute charts to find short-term imbalances. All right. Now that we know how to find imbalances, let us talk about how to actually trade them. Okay. So there are two key ways to trade imbalances. The first is trading the imbalance fill, because price often returns to fill imbalances before continuing in the original direction. So you have to look for retracements into the imbalance zone, right? You have to look for retracements into the imbalance zone and enter when price shows signs of rejection. In this particular example, well, we actually had a reversal eventually, even though the imbalance got filled, but we had a reversal. All right. But in some cases, you might actually get an imbalance fill. And then once the imbalance has been filled, you might find rejection candles or maybe a continuation pattern. If you find such, then you can enter in the direction of the original trend, because you can see that the original trend was a sell trend. So if you find such an example, you can enter in the direction of the original trend. Okay. Then another way to trade imbalance effectively is trading the continuation after the imbalance. If an imbalance aligns with strong momentum, you can enter a trade in the direction of the move. Okay. Let me see if I can find, an example of, okay, I think we have an imbalance here. Or not that, not really. Okay, I think this is where we had an imbalance. So if an imbalance aligns with strong momentum, you can enter in the direction of the move. You can see that price came down back and filled the imbalance, right, before continuing in a bullish direction. Okay, so you can just wait for a pullback, then enter when price resumes the trend. Confirm with volume indicator as well, okay, or price action signals like bullish or bearish engulfing patterns, or any other, you know, reversal candlestick patterns or continuation candlestick patterns. So by mastering these two strategies, you can use imbalances to your advantage and make smarter trading decisions. Now, timing is everything when trading imbalances. So here's what you need to know. For swing traders, use the 4-hour and the daily charts to find major imbalance zones where price is likely to react. Then for day traders, look at the 15-minute chart to the 1-hour chart to find intraday imbalances that offer trade opportunities. Then for scalpers, you can use the 1-minute to 5-minute charts to catch first imbalance fills or breakout trades. So imbalances are heavily used by smart money and institutional traders because they represent areas of high liquidity. If you can identify where institutions have left gaps in price, you can anticipate future movements and trade alongside them. So now let's quickly recap everything we covered. Imbalances occur when price moves aggressively in one direction, leaving gaps in liquidity. You can identify imbalances by looking for large candles with little or no opposite movement. The two best ways to trade imbalances are by catching the imbalance fill or trading continuation setups. So using the right time frames helps refine your entries for swing trading, day trading, or scalping. If you found this video valuable, hit that like button and let me know in the comments. Have you traded imbalances before? What is your favorite strategy? And of course, subscribe to stay updated with the best trading strategies. Turn on notifications so you never miss an upload. Thank you for watching, and I'll see you in the next video.